Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome back to Cut to the Chase. I'm Rajat Bhattacharya, your host for the podcast. Today, we will talk about the Fed's communication challenge as long-term bond yields hit multi-decade highs. We will discuss what Chair Kevin Warsh is likely to say in his debut speech at the Fed's annual Jackson Hole Summit on Friday, and why even a good speech only buys time. So let's start with the macro and market setup for Jackson Hole this year. Starting with July's Fed policy meeting. The Fed held rates last month despite inflation running above target for 5 years. 9 members voted to hold, but 3 regional presidents dissented, each calling for a 25 basis point hike. An unusually loud protest from a committee that prizes consensus. Then the data landed. On Warsh's side, US payrolls in July contracted 23,000 against consensus above 80,000, with another 103,000 jobs stripped from prior months. The 3-month trend collapsed to 20,000, barely a break-even level to keep the unemployment rate steady. Meanwhile, core inflation for July, based on personal consumption expenditures, came in at 0.2% month-on-month, 3.3% year-on-year. The 0.2% monthly pace is important because it's right at the bar New York Fed President Williams set for himself for deciding whether to support a rate hike. Core retail sales in July fell 0.4% month-on-month. Given this data backdrop, a rate hike this year looks unlikely. So why are bond yields rising? The 30-year yield rose above 5.3% last week, levels last seen in 2007. The so-called term premium, or the additional yield investors demand for holding long-term bonds to offset uncertainty, rose to its highest in over a decade. The long end of bond yields simply didn't like Warsh's July press conference, with investors fixated on his discontinuing forward guidance on rates and the vagueness of his answers around it. So here are the key objectives for Warsh at Jackson Hole. He needs to restore confidence that the Fed will do what it takes to cool inflation back to the Fed's 2% target, convey commitment strong enough to compress the term premium in bond yields and fiscal dominance fears. Then he needs to convince markets that a Fed doing less isn't a stability risk. And finally, make the case that his 5 task forces that are expected to deliver the reports by the end of the year are likely to address the structural challenges facing Fed policy making. Now, those are tough tasks. US macro fundamentals should help here. Softer payrolls, wage growth, and underlying inflation lets him sound contingently hawkish without signaling a September rate hike. We expect him to explain in more details the objective of his task forces to solve structural problems with measuring inflation, Fed communication, and the impact of AI on productivity growth, and a more explicit line on acting on lowering the inflation. This is likely to be market neutral. The main surprise would be opening the door to a September or Q4 rate hike. That would indicate that he has succumbed to bond market pressure. The fundamental problem here, and I repeat that this is the core issue, is more structural though. US debt has doubled in a decade to $40 trillion, almost 123% of GDP, and the deficit is back to 6%. Populism is structurally embedded across developed economies. Add to that a deluge of bond issuance from AI hyperscalers and Japanese repatriation risk as Japan government bond yields surge to multi-decade highs. The US Treasury last week doubled planned bond buybacks to cap long-term yields. The resulting rally in long bonds had no follow-through. Markets read it as suppression by fiat. With term premia compressed, the release valve is likely to be the dollar. We expect a modest, not dramatic, dollar weakness since the $900 billion of AI-driven inflows into the US stock market still finances a $1 trillion current account deficit. So in conclusion, Warsh may calm the long end of the bond market with his Jackson Hole speech. He can't fix the arithmetic behind it. For that, Measures to reverse the structural deficit or a growth slowdown will be required to lower long-term bond yields significantly. We continue to prefer the 3 to 5 year part of the bond curve for now and look for tactical opportunities to add medium-term bonds if the 10-year yield heads to or rises above 5%. And ultimately, a weaker dollar is how the US will probably have to pay its dues. That's all from me for today. If you like the podcast, please rate and like it. Have a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.